The federal government just handed you a brand new gift. If you are 65 or older, starting right now in 2026, you are entitled to an extra $6,000 tax deduction just for being a senior. No paperwork, no jumping through hoops. $6,000 wiped off your taxable income. And if you are married and both spouses are 65 or older, that number doubles to $12,000. Sounds incredible, right? Here is the part they are not telling you. For hundreds of thousands of American retirees, that $6,000 deduction is already being silently taken back. Not by a new law, not by a tax audit, but by a combination of IRS income rules and Medicare surcharge traps that are quietly working in the background, reducing your deduction and adding thousands of dollars to your Medicare bills at the exact same time. You get $6,000 with one hand, and the government quietly takes it all back, and then some, with the other. Today, I am going to show you exactly how this trap works, who it is hitting right now in 2026, and most importantly, the specific steps you can take today to protect your deduction before it disappears. Stay with me, because this could be the most important financial video you watch all year. Welcome back to the channel. If you are new here, we exist to do one thing: help Americans 65 and older keep more of the money they worked their entire lives to earn. Every single week, we break down the IRS rules, the Medicare traps, and the tax law changes that affect your retirement income before they cost you. Today, we are talking about the most exciting and most misunderstood new tax benefit for seniors in years. The brand new $6,000 senior bonus deduction created under the One Big Beautiful Bill Act. This is real. It is official. The IRS has confirmed it. And if you qualify, it can genuinely save you a significant amount of money. But there is a hidden side to this story that almost nobody in the financial media is talking about. By the end of this video, you are going to understand exactly what the $6,000 deduction is and who qualifies. You are going to understand the income phase-out trap that quietly steals it back dollar by dollar. You are going to understand why the $6,000 deduction does not protect you from Medicare surcharges. And you are going to walk away with 5 specific action steps to make sure you actually keep this money. This is not just a story about a tax break. This is a story about a tax trap hiding inside a tax break, and you need to know about it. This video is for educational purposes only and is not personal financial or tax advice. Always consult a licensed financial advisor or CPA before making any decisions. Let us start with the good news, because the good news is genuinely good. As part of the One Big Beautiful Bill Act, the major tax legislation signed into law in July 2025, Congress created a brand new bonus deduction specifically for Americans aged 65 and older. The IRS has officially confirmed this deduction. It is real. It applies starting with the 2025 tax year, meaning the tax return you are filing right now in 2026. Here is exactly what it is. If you are 65 or older by December 31st of the tax year, you can claim an additional $6,000 deduction on your federal tax return. This is on top of your regular standard deduction. It is on top of the existing extra deduction for seniors that has always existed. It is a completely separate, standalone bonus deduction. And here's the part that makes it especially powerful. It is available whether you itemize your deductions or whether you take the standard deduction. Most new deductions only apply to itemizers. This one applies to everyone. For married couples, where both spouses are 65 or older, the deduction doubles to $12,000 total. $12,000 off your taxable income. That is enormous. Let us put real numbers on what this means. If you are a single retiree in the 22% tax bracket, a $6,000 deduction saves you $1,320 in federal taxes. If you are married in the 22% bracket with both spouses over 65, the $12,000 deduction saves you $2,640. Real money, real savings. The deduction is currently scheduled to be available for tax years 2025 through 2028, unless Congress extends it. Now, all of that is the good news, and I want you to hold on to it, because now I have to show you where this gets complicated. Stay with me, because what I am about to share could save you thousands. There are 2 major traps hiding inside this seemingly generous deduction, and millions of retirees are going to walk right into them without ever knowing it. Here is the first trap, and it is a sneaky one. The $6,000 senior bonus deduction does not apply to everyone equally. It has an income limit, a phase-out, and that phase-out begins at a lower income level than most retirees expect. Here is how it works. If your modified adjusted gross income, your MAGI, is $75,000 or below as a single filer, you get the full $6,000 deduction. If you are married filing jointly and your combined MAGI is $150,000 or below, you get the full $12,000 deduction. Sounds reasonable, right? But here is where it gets painful. For every dollar your income rises above those thresholds, you lose 6 cents of your deduction. That is a 6% phase-out rate. So if you are a single filer earning $76,000 instead of $75,000, you lose $60 of your deduction. At $80,000, you have lost $300. At $90,000, you have lost $900. And by the time your income reaches $175,000 as a single filer, your entire $6,000 deduction has completely disappeared. For married couples, the full phase-out hits at $250,000 in combined income. Now here is why this matters so much. For retirees, income is not just your paycheck. Your income includes Social Security benefits that may be taxable. It includes pension payments. It includes dividends and interest. It includes capital gains distributions from your investment accounts. And critically, it includes required minimum distributions from your traditional IRA or 401k. That last one is the killer. Because RMDs are mandatory, you cannot choose not to take them. And if your RMD pushes your income above $75,000 as a single retiree, you start losing your $6,000 deduction automatically, quietly, without any warning on your tax return. Financial advisors have started calling this a stealth tax on retirement income. The deduction does not announce itself when it disappears. It just quietly reduces, 6% at a time, while your headline tax bracket stays exactly the same on paper. Here is a simple example. Take a 68-year-old widow living on Social Security and a small pension. Her total income comes to $78,000. She is $3,000 above the $75,000 threshold. So she loses $180 of her deduction. Not devastating, but she did not know about it. Nobody told her. And it is just the beginning of the trap. Because the income phase-out is just the first problem. The second problem is far more expensive. This is the part that is genuinely shocking, and it is the part that financial experts and major publications have confirmed in 2026. The $6,000 senior bonus deduction reduces your taxable income. That is real and that is helpful. But it does not reduce your modified adjusted gross income for Medicare purposes. And that distinction is absolutely critical. Let me explain why. Medicare uses a system called IRMAA, Income-Related Monthly Adjustment Amount, to determine how much you pay for your Part B and Part D premiums. If your income is above certain thresholds, Medicare charges you extra, sometimes a lot extra. In 2026, the standard Part B premium is $202.90 per month. But if your income crosses the first IRMAA threshold, your premium jumps to $284.10 per month. At the highest income tiers, retirees pay $689.90 per month for Part B alone. Here is the critical rule. Medicare calculates your IRMAA using your MAGI from 2 years ago. Your 2026 Medicare premiums are based on your 2024 income. Your 2027 Medicare premiums will be based on your 2025 income. But here is the trap specific to the $6,000 deduction. The $6,000 senior bonus deduction, the standard deduction, the extra senior deduction, none of these deductions reduce your MAGI for IRMAA purposes. Medicare starts with your adjusted gross income before any of those deductions are applied. Then it adds back certain items like tax-exempt interest to arrive at the MAGI it uses for your premium calculation. What does that mean in plain English? It means you can claim your full $6,000 senior deduction on your tax return, and your Medicare premiums will be completely unchanged. The deduction saves you money on your income tax bill, but it does nothing to reduce your Medicare surcharges. So the trap looks like this. A single retiree earns $112,000 in total income in 2025 from Social Security, a pension, and a small RMD. She claims the $6,000 senior bonus deduction. Her taxable income for federal income tax purposes drops to $106,000. Her federal tax bill goes down. But for Medicare purposes, her MAGI is still $112,000. That is above the $109,000 IRMAA threshold for 2026, which means her Medicare Part B premium is $284.10 per month instead of $202.90. She is paying an extra $81.20 every single month, nearly $975 more per year, and that surcharge continues for the entire year, based on income she earned 2 years ago, that she cannot retroactively change. She saved $1,320 on her income taxes, thanks to the $6,000 deduction, but she is paying $975 extra in Medicare surcharges. Her net benefit from the deduction is just $345, not the $1,320 she expected. Stay with me because what I am about to share could save you thousands. And remember, the IRMAA system uses income cliff brackets. If your income crosses a threshold by even $1, your entire premium moves into the next bracket. Not just the dollar over the line, your entire annual premium. That is why IRMAA planning is so critical. $1 of additional income can cost you thousands. Now I want to show you what happens when both traps hit at the same time, because for a significant number of retirees in 2026, they will face both simultaneously. Imagine a married couple. Both are 67 years old. They receive a combined $48,000 from Social Security. They have pension income of $60,000, and they have investment income of $50,000. Their total combined income is $158,000. First trap. Their income is $8,000 above the $150,000 phase-out threshold for the married joint $12,000 deduction. So they lose $480 of their senior bonus deduction. Instead of $12,000, they get $11,520. Not catastrophic, but they did not plan for this. Now, add an RMD of $65,000 to their income. Their combined MAGI becomes $223,000. That is $5,000 above the $218,000 joint IRMAA threshold. Now both spouses face IRMAA surcharges on their Medicare premiums. For a married couple, that jump from no IRMAA to the first IRMAA tier costs approximately $2,297 per year combined, for just $5,000 of extra income over the threshold. Meanwhile, their senior bonus deduction is also being eroded by the phase-out. At $223,000 combined income, they are $73,000 above the $150,000 threshold. That is a loss of $4,380 of their deduction. Their $12,000 deduction is now just $7,620. Two traps, hitting simultaneously. Neither one announced itself, both happening automatically based on their income level. This is exactly what financial advisors are calling the stealth tax on retirement income in 2026. Now let us talk solutions, because there are real concrete strategies you can use right now to protect this deduction and manage your Medicare exposure at the same time. Strategy number 1, know your income thresholds before year end. The most powerful thing you can do is calculate your projected 2026 income right now, while you still have months to make adjustments. Add up your Social Security income, your pension, your dividends and interest, your planned RMD, and any other income sources. Compare that total to the $75,000 single or $150,000 joint phase-out threshold for the senior bonus deduction, and separately compare it to the $109,000 single or $218,000 joint IRMAA threshold. Knowing where you stand gives you time to act. Strategy number 2, use qualified charitable distributions to reduce your MAGI. If you are 70 and a half or older and you have an IRA, you can donate directly from your IRA to charity through what is called a QCD. In 2026, you can give up to $111,000 per person this way. The critical advantage is that a QCD never hits your tax return as income. It reduces your IRA balance, satisfies your RMD requirement, and does not raise your MAGI for either the senior deduction phase-out or IRMAA purposes. This is one of the most effective tools for managing income in retirement, and it is completely legal under IRS rules. Strategy number 3, manage your RMD timing and amounts carefully. If your RMD is pushing you over the senior deduction phase-out threshold, or the IRMAA cliff, consider whether there are ways to reduce future RMDs through strategic planning. Roth conversions in earlier years reduce the balance of your traditional IRA, which reduces future mandatory withdrawals. Every dollar you convert to Roth before your RMD years begin is a dollar that will never count toward your income thresholds later. Strategy number 4. Appeal your IRMAA surcharge if your income dropped. Remember, your 2026 Medicare premiums are based on your 2024 income. If something significant changed between 2024 and today, you retired, lost a spouse, got divorced, or your income dropped substantially, you may qualify to appeal your IRMAA determination. You file Form SSA-44 with the Social Security Administration and request that they use your more recent income instead. The approval rate for legitimate life-changing events is high, and a successful appeal can immediately reduce your Medicare premium to the standard rate, saving you hundreds or even thousands of dollars per year. Strategy number 5. Do not confuse tax deductions with MAGI reductions. The $6,000 senior bonus deduction reduces your taxable income for federal income tax purposes. That is valuable. But it does not reduce your MAGI for IRMAA purposes. For Medicare planning, you need strategies that reduce your actual gross income, not just your deductions. That means QCDs, Roth accounts, timing of capital gains, and careful withdrawal management. A deduction on your tax return and a reduction in your gross income are two very different things, and confusing them can cost you thousands. Now let me give you 5 specific things you can do right now to protect yourself. Action Step 1. Confirm you qualify for the full $6,000 deduction. You must be 65 or older by December 31st of the tax year. You must have a valid Social Security number. And your MAGI must be at or below $75,000 as a single filer or $150,000 as a married couple to get the full amount. If you are above those numbers, calculate exactly how much of your deduction is being phased out. Your CPA or tax software can help, but you need to know this number. Action Step 2. Pull your 2024 tax return and check your MAGI. Your 2026 Medicare premiums are based on your 2024 Modified Adjusted Gross Income. Look at line 11 of your 2024 Form 1040, your adjusted gross income. Then add back any tax-exempt interest from line 2A. That combined number is your MAGI for IRMAA purposes. If it exceeded $109,000 as a single filer or $218,000 as a joint filer, you are already paying IRMAA surcharges this year. And your 2026 income decisions will affect your 2028 premiums. Action Step 3. Calculate whether a QCD makes sense for you. If you are 70 and a half or older and you have a traditional IRA, call your IRA custodian this week and ask about setting up a qualified charitable distribution. Even a modest QCD of $5,000 to $10,000 directed to a charity you already support could keep your income below a critical threshold, protect your full $6,000 senior deduction, and prevent an IRMAA surcharge. The 2026 QCD limit is $111,000 per person. Action Step 4. If you experienced a major life change in 2024 or 2025, file Form SSA-44. If you retired, lost a spouse, divorced, or had any other major income-reducing event, you may be able to appeal your current IRMAA determination. Download Form SSA-44 from ssa.gov and submit it to your local Social Security office. Include documentation of the life event. If approved, your Medicare premium can drop immediately to the standard rate. Action Step 5. Schedule a tax planning meeting before September. The strategies that protect your $6,000 deduction and manage your IRMAA exposure all have year-end deadlines. Roth conversions, QCDs, capital gains harvesting, and income timing decisions for 2026 all need to be made before December 31st. If you wait until tax filing season in early 2027, it will be too late to change anything about your 2026 income. Act now, while the window is still wide open. Here is what I want you to remember from everything we covered today. The new $6,000 senior bonus deduction is real, it is generous, and it can genuinely reduce your tax bill if you qualify. But it is not a simple windfall. It comes with an income phase-out that quietly erodes it for retirees above $75,000. It does nothing to protect your Medicare premiums from IRMAA surcharges. And when both traps hit at the same time, retirees can end up worse off than they expected, even after claiming their deduction. The good news is that you now know what most retirees do not. You know the traps, you know the thresholds, and you know the strategies that can protect you. Knowledge is the most valuable retirement tool you have, and that is exactly why this channel exists. If this video helped you today, please subscribe right now. Every week we bring you exactly this kind of retirement tax intelligence, the real numbers, the real rules, and the real strategies that your accountant might not have time to explain. Subscribe so you never miss an update that could cost you thousands, and share this video with someone you love who is 65 or older. They may have already heard about the $6,000 deduction and think they are getting a windfall. They deserve to know the full story. Next week, we are going deep on Roth conversion strategies for 2026. Specifically, how to do conversions that reduce your future RMDs without accidentally triggering a Medicare surcharge 2 years from now. That video could save you serious money. You do not want to miss it. Until then, stay informed, stay protected, and keep more of what you earned.